Right, tonight I want to convince you paper 6 you can handle. It's not that difficult in paper. Your papers 2, 3, and 4 are officially due this week. If you're a little late, that's not bad, except for the semester's going to start crowding up on you. If you need help on paper 3, maybe set up some time Saturday or Sunday afternoon. I'm pretty distracted Tuesday, Wednesday, Thursday, just because there's so much going on. But Friday, Saturday, Sunday. Friday, I'll probably be on a bike for Friday evening or Saturday or Sunday afternoon or Monday morning. I don't have as much to grade. This last weekend was crazy. I had 2 massive classes to grade. But so we got to get you caught up. But paper 6 is not too bad. Some of you have me before. So let's just, the bottom line on paper 6, it's a discount rate. And we're, they want me to do WACC in this class. I really don't want to do weighted average cost of capital. I really want to stick with cost of equity capital, just to keep it simple. Because coming up with cost of debt is a lot of extra work, and it's really not necessary for this paper. We'll talk later when we do valuation what on papers. I'm sorry, I said 6. This is really 5, right? I used to have a paper 2. All right. So by KE, what do we mean? We mean the capital asset pricing model. Now, I don't need 7 paragraphs on CAPM, what it means, the theory. Your boss knows that. You would never put that in a paper like this. All right. So I don't need that. You can just say we're going to use the capital asset pricing model. So what is CAPM? Pretty straightforward. Risk-free rate plus beta times a market risk premium or equity risk premium. So you need 3 numbers. The risk-free, I'm saying you can just essentially use the 10-year treasury. So that's gotten easier. With quick note on its recent history, I think that is probably enough to get you out of there. So something along the lines is many have discussed about needing to adjust the 10-year treasury because it's been so low, but now that we're back to more normal levels, I'm just going to use a 10-year. One thing you could do here is put a graph. That wouldn't be bad, just to show that the 10 years back to more normal levels. That makes it pretty simple. So you're off the risk-free rate. It's easy again. Market risk premium. We're going to use the implied approach. Stocks expected return equals the required return. So the market risk premium is the return on stocks minus the risk-free rate. We're going to use the implied approach. The implied approach says a stock this expected return should equal the required return. We can't get the required return anywhere, but we can come up with the expected returns. So you just say that in your paper in your own words. And if you're not sure exactly, go look at some prior papers recently because they would have done it. You got to put it in your own words still, but the expected return should equal the current market dividend yield, not your stock's dividend yield, but the market's dividend yield, plus maybe buybacks. We'll talk about that today. Plus expected earnings growth. Now, the expected earnings growth is really important because you're probably going to need that in paper 6 for your terminal growth. So what you do here for this growth rate will probably be really important for paper 6, because in paper 6, you're going to need a terminal growth for your company. For most people, that's going to be long-term economic growth plus or minus something, depending. So that number is going to provide a double benefit. So current dividend yield, how do you get that? Just use the SPY yield. That's easy. So that's a number you can just look up. That's pretty easy. Just go into Yahoo Finance, type in SPY, and just get its current yield. That's easy. The market risk premium. I'm sorry, the expected earnings growth is a function of GDP growth, nominal GDP growth. History and forecast. You got some graphs to help you with that. So that's what we talked about before. You got productivity growth, labor growth, inflation. So you build up those pieces and you have something that you think long-term GDP growth is going to be. All right, so we covered all of that. So, and you also have previous papers that help you with that quite a bit. So the only thing we have left here is the buyback yield. I recommend you put the buyback yield in there, although with treasuries being back up to 4%, it's not as critical as it was a couple of years ago, but it probably should be in your paper. One thing I've been meaning to do, I just haven't gotten around to it, is to see if stock buybacks have materially changed since the time this article was written. My guess is they're probably just as strong, except for maybe this year, but this year they cut back just because the economy, people are uncertainty. So I like this paper. It is very dated, but they haven't updated it. So just the theories in here very strong, and it's got Roger Ibbotson, you know, which is, he's the market risk premium guru, most respected on this issue. So they're saying the dividend discount model, which we'll use in paper 6, if you just use the dividend yield, you're going to understate expected returns. And they're talking about the market risk premium here, and they're not talking about for individual stocks. So again, this is all about the market risk premium. And he's talking about the implied approach. So cash flows to corporation supply is what drives stock returns. These cash flows participate in underlying growth in real economy. So what is he saying? Firms increase their dividends, they increase their stock buybacks because the economy's doing well, the company's doing well, cash flows are doing well. So we can't ignore buyback because it's part of that equation. So in recent decades, a new source of stock market supply has emerged as companies increasingly use their share buybacks instead of dividends. Stock market buybacks are the dominant source of payout. So it used to be buybacks versus new issuance was 0, even slightly negative. Then they, not only did buybacks take over new issuance, they actually were higher than dividends. That's the part I want to see if that's still the case. Many practitioners continue to rely on traditional supply models that use dividends. Remember what we said earlier, dividends, we're really after free cash flow. And we're using dividends as a proxy for free cash flow. If that's the case, and a lot of firms are doing buybacks is a free cash flow just as much as dividends. The one thing I don't know if they address it in here, it's something we might talk about is, what about the firms that are borrowing money to buy their stock back? Because that's obviously not a free cash flow. If you're having to borrow $1 billion to buy $1 billion in cash, you don't have a free cash flow. You're just recapitalizing the firm. So it seems like, I don't think they address that here, but we'll see. So they're going to develop a model of stock returns based on total payouts. So stock returns, this is not an individual company model. This is the overall market, which provide not only a more consistent framework for examining a historical source return. So they're also trying to say what model better explains the past, which is important. Independent changes in payout policy, but also a more robust return forecasting model that being related to the growth in the real economy. Miller Modigliani, I remember those two guys, should be indifferent about whether you get a dividend or you get a stock buyback. You're getting cash from the company. That's all you should care about. This logic also applies to share issuance, where investors receiving the same return whether they add proportional. So they're trying to make it the point, it doesn't matter what kind of stockholder you are, whether you're investing more, investing less, taking the buyback, reinvesting the buyback, it shouldn't matter. It impacts your return in a very similar way. So they go through the different types, those that take the buyback and reduce their ownership, because if you get a stock buyback, you're essentially getting cash from a company, and you're not going to participate there. If you can keep your ownership, if you increase your ownership or whatever, whatever you have in the stock, when they do the stock buyback, the firm has less cash, but your ownership in their earnings is higher because you have a stock and someone else got out of the stock. So you have a higher ownership in the company. We estimate buybacks on their basis of the increase in company's treasury stock, excluding repurchased shares earmarked for compensation. Some people have asked that question. What about all these stock option plans? They adjust for that. They show the change. Here's stock buybacks. Here's dividend yields. And that's what they're saying. Somewhere around 2014, 2015, the two things switch. So I want to go back to 2015 and see if that continues. I do think there's a sector dominance to this. We've noticed the restaurant and food companies have been buying a lot of stocks back, so much that their net worth has gone negative. Tech stocks obviously have done that a lot. And Ashley, was it Dominic that had a negative net worth? Who was the other that had a negative net worth? So Ashley and one other. I remember who that was. But if you're one of those that have a negative net worth, I'll work on that tomorrow and see if I can find a way so you can at least do the last part of your paper 3 on ROE. But yeah, there's definitely going up, but not every industry is equal on this. So I think there's some shifting. Buybacks have fundamentally different impact on return generation. Although paybacks via dividends increase the income, buybacks increase the price return per share. Traditional return models are often wrongly applied in practice, given investors' tendency to combine current yields with historical per share growth rates. When relying on historical per share growth rates as a proxy for future growth, investors underestimate the fact that while any shareholder benefits from the underlying growth, buybacks increase buy and hold investment portions of the company over time. So I was talking about if you own the stock and they do buybacks, and you keep your shares of the company, your ownership went from 0.7% to 0.78%. So that means you're going to get a larger growth in the company going forward. Note that buybacks do not affect the dividend yield, but do increase growth because the investment proportion of the company increases. So it's increasing the growth term, which is exactly what we're doing. Suggests that more than 97% of realized returns are related to supply of total payouts. Overall, this finding suggests that the realized level of returns is almost entirely attributable to supply of total payouts. What they're saying is when you just look at dividends, your R squared or your explanatory power is just not very strong. When you include dividends and buybacks, you can explain a lot more of the market. Buybacks are more sensitive than dividends to variations in the company's earnings because buybacks offer greater flexibility than dividends. And that's one reason a lot of firms do buybacks is there's this, especially for tech stocks, this kind of connotation. If you pay dividends, you're old economy, you're an old company. And so buybacks allow them essentially to give cash back to their investors without looking like some old utility. The problem with that is when you buy back your stock, you're essentially admitting to your stockholders, we have nothing better to do with this money. Isn't that what Miller and Higliani said? If you can't reinvest in the firm in good projects and give it back to your stockholders, they're admitting, hey, we give up. Now, if they're borrowing money to pay buybacks, then they're just making themselves riskier. That's a different story. So buybacks have been a key driver of the short-term volatility in the growth term. So buybacks are important, but they're less predictable. They're more volatile, so they do create some noise. Long-term growth expectations for financial assets need to be anchored in a reasonable growth expectation for the overall economy. Have you heard that before? Isn't that what we said last class? After all, financial assets cannot outperform the economy indefinitely because the assets will ultimately become the economy itself. I think I said almost that exact thing. So that growth in earnings per share in U.S. stocks is in line. So Roger Ibbotson agrees with me. That makes me look smarter, not him, but that's good. I'm glad he agrees with me. New issuance increases the number of shares outstanding, which for a given level of earnings leads to lower earnings growth, which was the case in the past. Firms issued more than they bought back. Per share growth, such as growth in earnings per share, is the natural stock market equivalent of the growth in income per invested capital. Buybacks constitute a payout with the money that investors receive from tendering their shares to the repurchasing coming flowing back to the economy, and thus must be excluded from the stock market measure of invested capital. Prior studies on the supply of equity returns have made no adjustments for this. So we've seen that before. My chart's very similar to that. The long-run expected return of any of the supply models discussed in the article can be expressed in terms of two basic components: payout yield and growth. So payout yield is the dividend and the stock buyback, and then growth. Expected real return, payout yield plus real growth plus interaction. This is the part where I haven't adjusted. There's an interaction between those two, but it's not that material, so I think we ignore it. The dividend model, if you use that alone, gives you a 0.58% real return, lower than that of the total payout model. The expected real return based on dividend model is 3.63, whereas the expected return based on the total payout is 5.11. The bulk of the 1.58 point difference can be attributed to the fact that dividend yield is 1.29 points lower than the total yield. I usually add, say, 1.5%, but this is only going through 2014, so who knows what's up. My guess is we probably see more buybacks until this year, and it probably strengthens their argument. So that's their argument. I have not seen this updated by anybody since then, so maybe there's someone else doing this kind of study. But if you want to, add 0.75% to 1.5% to your expected return or buybacks, or at least acknowledge it. Now, here's where you can cheat a little bit because you're doing papers 5 and 6 together. Now, I'll tell you, they don't do this in practice. This is for college, but they do this in practice. So paper 6, you get your discount rate. Then you get the paper 5, you get your discount rate. That changes it to 5. You get your discount rate. Then you get the paper 6 where you value the company, and you get really horrible valuations. Your stock's trading for $332, and you get a valuation of $17. Most students, the first question they ask is, what did I do wrong? Which is not the right question. The first question to ask is, where do I disagree with the market? But most students start with, what did I do wrong? So it shows the great confidence students have in their own work. But if they then go back to paper 5 and say, you know what, I'm not going to use that buyback yield. I don't really think that's right. Oh, look, now my valuation is $287. Yeah, I think that was right. I probably shouldn't. That happens a lot. That's fine. Part of this is we're just, you're not going to actually go out and recommend this stock for actual purchase in a $100 million portfolio or something. You're going through the process, learn the process. So if you want to manipulate the numbers so you have something that looks really good on LinkedIn, that's fine with me. I'm not really that picky on that. You get to go back and forth and edit it. But I do think this does happen in real life as well, because you can make small tweaks in your numbers. Like, you love this company. Well, I think this company is great. You do your evaluation, you don't get a high enough number. It's like, oh, you know what, that growth rate, it should have been 6. I used 5.3, but 6 makes, people do that all the time. We tend to back into the number we already had in our mind for some reason. So I want you to at least acknowledge it. Maybe don't get too committed here. So have it there ready to go, then finish paper 6, and then come back and decide what you want your final discount rate to be. So, all right. So that gives you everything but what? Beta, right? It's the last thing we have is beta. So some of you have had me before, so sorry you got to sit through this again, but it doesn't hurt. Hear this again. So beta, you've probably seen it in at least 3 classes. We keep teaching beta to you over and over again. So beta is what we call the appropriate, or oh, I forgot the word, but it's the measure of risk that gets priced into a stock. So a stock has a lot of risk, but 70–80% of it we can completely ignore because it gets diversified away in a well-diversified portfolio. So it's significant. Beta only captures, but it depends. And in some years, like 2008, beta captures a larger percentage of the risk. For most companies, most of the time, beta only captures 20, 25, 30% of the risk. Most of it disappears because of diversification. One company's doing well, another's doing badly at the same time. A lot of that's noise, just because of earning cycles and all those kind of things. So beta is measuring the risk we want to put into the pricing, which means you could have a company whose stock is incredibly volatile, but it's considered to be a low risk stock. What would be an example of that? The most obvious example. What's highly volatile but reduces risk? A gold stock. Gold stock is very, their calculated beta 0.13. That's a low beta, isn't it? What's the beta of the market? 1. If you look at this company, it's probably more volatile than a lot of companies. Maybe not as volatile as Nvidia, but probably more volatile than Walmart or Costco. It's a very volatile company, yet its beta is really low. Why? Because gold tends to do well in a crisis, so it provides that diversification. So we're going to ignore most of the risk of this company, and the risk we're going to look at, we're going to say is uncorrelated. So much of it's just noise all over the place. There's some strike in South Africa or whatever, or in Peru, and then suddenly, gold prices jump up or down, whatever. And then there's the fact that gold, when it does move with everything else, correlated way, it moves in a very risk controlling way. So there doesn't have to be necessarily have to be a correlation between volatility of the stock and beta. That'd be an interesting study, right? If y'all looking for a honors college dissertation, that would be an interesting one. Is there a correlation between remember in beta, the standard deviation of the stock is not in there anywhere. It's completely left out of the equation. But is there a correlation between beta and the volatility of the stock? Do high volatility stocks have higher betas than low? I mean, an interesting question. It might be that companies that are in cyclical industries tend to be more volatile, so there will be a relationship, but you'd have to check that. But we're ignoring volatility, which is total risk, and that equals systematic plus unsystematic risk. Total risk. I say volatility, what do I really mean? Standard deviation of the stock return. You can say the stock return or the stock price, either way. The stock return includes dividends, but the stock return. So that's total risk. We break that in between systematic risk and unsystematic risk. Beta measures in a relative way systematic risk. It doesn't measure systematic risk. It doesn't say, hey, this stock has a beta of 1.3, so its systematic risk is 1.3. If you have a beta 1.3, what do we say? Stock has 30% more systematic risk than average stock. It's more cyclical, it's more susceptible to recessions. So it's a relative measure. The beta of the market is by definition 1. What is the market traditionally? Anytime you see a beta, what is it almost always against? S&P 500. Why is that? Who knows? Now, if you read technically the way I was taught it, the market should be every asset in the world, not just stocks. It should be real estate and bonds, but that's obviously not the case. You really can't include bonds in this because somewhat of beta is assuming a normal distribution. With bonds aren't normal distributed. They're very left skewed. You have an upside of the coupon and a downside of losing all your money. So you really can't do real estate and all these others. But then it should be the entire world stock market. But what do? We use the S&P 500 and then we add other risk premiums for small cap, for international, for emerging markets. So that's been the tradition that has built up over time. The S&P 500, which is about 85–90% of the U.S. stock market, and so thus probably close to half of the world market, is a significant part of the world market, but there's a lot of stocks not in our measure of beta. I think the other reason we don't use all stocks is because I think currencies themselves are a lot of noise that's a little bit tough to assess. And so that's why Dr. Damodaran gives you risk premiums by country that you can add on. So if you're using another, so Timer does maybe something Timer in advance. You might go to Damadera and see, hey, do I need to add an extra risk premium for my country? I forget what country you're in. Canada. Yeah, probably not a big one. And what country you're France? Yeah, there's probably not a big risk premium for those two countries, but you could easily Damadera country risk premium. You can use this chart if you want to. If you're doing a small cap stock, you can certainly do the FAMA French kind of thing of adding whatever that standard risk premium is. Dr. Ibbotson has a small cap premium as well. So I didn't bring my t-shirt, but I have a t-shirt that says beta is not a number you get from Yahoo Finance. I'm probably the only person in the world with that t-shirt. In one of my classes, my EMBA class, I told them this like 7 times. I had a sweater on. I said, man, it's getting hot in here. I took the sweater off. I had the t-shirt on. They're like, oh. But I didn't get it on the tape because we forgot to record the class, but I thought it was pretty funny. I'll do it this semester, see if I can catch them. So what is the beta in Yahoo Finance? They even tell you. What is this beta? What does that say right there? 5-year monthly. What does that mean? It's the regression beta using last 5 years of data, last 60 months of data. Is that a good place to calculate beta? I don't think so, but we're going to do it. I'm going to show you how we're going to do it. Let me show you the process. It's in the class notes, but we're going to forecast beta. So I'm going to believe that beta is not a number you go look up, you get out of Bloomberg, you get off of Yahoo Finance. Beta is a number you forecast beta just like forecast growth. It's an assumption you have to come up with. And how do you forecast it? So I have 4 steps. Anybody remember the steps? This is the depression part of the class. Students have me before, don't remember anything they've ever learned in my previous classes. Someone's bound to remember it. You got to do it on the exam.
It was I think it was like historical.
Historical is the 4th step. We will do that.
First one was.
Yeah, what kind of company is? Define
Yeah.
company. Defensive, cyclical, in the middle. That's where you start with. If I'm looking at Ford Motor Credit, is that defensive or cyclical? Sounds really cyclical to me. One class I looked up Ford on Yahoo Finance, their beta was 0.65. Does that sound like the right beta for Ford? 0.65. Had a student come in, she's about to present her team's project. And she said, can you just look over it? And it was this retail company, and their beta was negative 0.7 or something. I said, why is your beta negative 0.7? And what was their answer? That's what was in Yahoo Finance. What retail company is a negative 0.7? Remember, if your beta is negative 0.7, that means that stock can have a return lower than the risk-free rate, and you'd be perfectly happy with that. You're going to buy that stock to reduce your risk below even treasuries. Does anybody have a stock like that? If someone tells you Walmart's beta is negative 0.6, you say, hey, I'll be comfortable with the 2% return on Walmart. That'd make me happy. I seriously doubt it. If you can buy treasuries at 4%, what are you going to do? How about the treasuries at 4%? If Walmart's price, tell me the way it's going to reduce the risk, I don't buy it. So I don't believe in negative betas. So I told her, first thing I do is change your beta. And that's what they did. And they got a really high grade just because of that one thing. I said, I should get some of your grade. All right. So first define the company. And then the next 2 have to do with what word? Leverage, right. What are the 2 types of leverages? Financial leverage, operating leverage. Now, leverages generally don't change your beta as far as being above 1 or below 1. What they do is they either move you closer to 1 or further away from 1. So if you got a stock like Costco, beta in the 0.4, 0.6 range, but you see they got a lot of debt, they might put you up at 0.7, 0.8. Like Kroger's a good example. Kroger is definitely a low beta defensive stock, but they have a lot of debt. That's not going to take them from 0.5 to 1.7. I mean, unless they have $9 billion in debt and $2 in equity or something ridiculous like that. Now, I know there's a formula for this, but I don't require you to use it. You can if you want to, but you can get unlevered beta and leverage it up if you want to, but you don't need to do that. So I'm going to show you how I do it. All right, so operating leverage, so financial lever is use of debt. Operating leverage is level fixed costs. Both of those do what? They make the firm more volatile. More fixed costs, you're going to have much more volatile earnings. More debt, you're going to have much more volatile earnings. Okay, so just both of those. The only one we adjust for formulaically is debt, but we should be adjusting for both of them. I've never seen a formula for operating leverage where you can actually just plug numbers in because it's a hard number to calculate. And then what do we do in historical? I do rolling 5-year monthly. And I'll show you this. So I started doing this, oh my word, it must have been 20 years ago. So one of our portfolio managers that we used, DSI, I don't even know if they're in business anymore, but their founder was visiting San Antonio to meet with us. I said, hey, will you come talk to my security analysis class? He said, well, depends on how much I'm allowed to step on your toes. So you can step on my toes all you want. So he comes in, and the big thing he presents is why he doesn't believe in beta. And this is what he showed. He showed this for Merck. And he says, if this doesn't prove beta doesn't work, I don't know what. So I looked at that, and I'd agree with him. But where I disagreed with him was he threw out beta entirely. What I thought was, let's throw out beta as a regression, historical regression that we just use. And instead, I love the concept of beta. It really does. I do think it gives you a good way of adjusting for risk that's very logical if you throw away the fact that you can just look it up somewhere. So some companies are very risky. They should have a higher discount rate. I think these are the things that do make companies risky. They're very sensitive to the economy. They got a lot of fixed costs, got a lot of debt. That sounds like a really risky company to me that I should be getting a higher return for. Does that make logical sense to everybody else? So beta makes perfect sense, doesn't it? One thing I like about William Sharp is when he came up with CAPM, he did what I think we should all do. The first question he asked is, if every investor did this for buying stocks, what would the stock market look like? Would the world be rational? Would it make sense? That's the way you should do theories. You have a theory to say, hey, if everybody did this, that's, you know, the option pricing model. If everybody did this, what would the world look like? So, all right, so let's talk about beta as a forecast. So let's do McDonald's. So let's start off with step one. What kind of company is McDonald's? Cyclical or defensive? So we go into a recession. Well, okay, so more defensive than cyclical. So, boy, I can't, whatever the word is. No. Is it defensive?
Yes.
No, defense. Okay, I don't know, but it's close enough. Oh, the defense. I'm doing divisive. Okay, defensive, something like that, maybe.
Yes.
All right. It's y'all are gonna be teachers one of these days. It's hard to think and talk at the same time. It really is very difficult. Why do I say leans defensive? So this isn't Costco, is it? I mean, how many people say, man, I'm worried about losing my job, I'm gonna start eating McDonald's? Now, there's no doubt McDonald's is a cheap place to get calories. You look at how much you're spending per calorie, it's a pretty cheap place to get calories if you not worried about being healthy. But Costco's even cheaper. You can come out with a crate of calories. You know, it might be all ranch style beans, 7 gallons, but it's going to be pretty cheap per calorie. So it leans defensive, but it is low cost. It's a cheap way to get. Even in the bad economy, people still stop by McDonald's because it doesn't cost that much. So it leans defensive. I don't think it's a low beta company. We can certainly look on Yahoo. You might not want to do this because it's going to corrupt you, but look on Yahoo Finance. and see the beta they show, 0.59. That's way too low for McDonald's. I don't believe McDonald's is a 0.59 beta company. To have the right company, sometimes I type in. So that's way too low. But we'll look at it and we'll see. And then step 2. And step 3 is leverage. So this is where we're going to bring up this spreadsheet. I thought I saved it out here, but if not, well, let me show you, because you're going to need to know where it is in Yahoo Finance. So, I mean in Blackboard, excuse me. So I put it under models and templates. It's this one here for paper 5, data from Bloomberg for relative value, financial and operating leverage. All right, I think I showed y'all that earlier, but let's look at it. So when you bring up this model, the first thing you should do is go find your stock on the second page. And then I'll explain what I'm doing here. So go find your company. Make sure you got them, 1708. And if you want to, you can just type that number in. So I got my number. Oh, why did I pick McDonald's? Their net worth is negative, so I should have picked a different company. So let's do Wendy's. I'll tell you what, we'll do Wendy's. When's the last time y'all ate at a Wendy's? Anybody? So you have it this year eaten? Has anyone not eaten at Wendy's this year? No? Long time. I used to really like them. I thought their hamburgers. What I find with hamburger places, I like one just because it's different. And then you eat there 3 times and then you're sick and tired of them. So, all right, 2940. Hopefully their net worth is not negative. All right, there we go. Okay. So here's Wendy's. So what are we looking at? So here's my theory. Some of this is basic finance. Some of this is my theory. So here you got sweet theory. My theory is high fixed cost should equal high vol of net margins. If firms have high fixed costs, their net margins should be much more volatile. And by net margins, I mean EBIT or EBITDA. Why don't I use net income? Because that's financial leverage, right? We don't want interest expense in there. So look at their margins, their EBIT margin, EBITDA margin. If they have a lot of fixed costs, that should be really volatile. Now, elastic demand, I don't have that in here, but it kind of falls under this operating leverage. Elastic demand should cause volatility in gross margin. If their customers are very sensitive to price, when their cost of goods sold go up, they're not going to be able to raise their prices because their customers are very price sensitive. So their gross margins should be really volatile. So some firms may have high gross margin volatility, but they can manage that below the line. Some firms may have really steady gross margins, really volatile EBITDA margins. It's just any combination. So this is a little different. This is elasticity. How much can they move their prices? So you think about a firm like a tobacco company, boy, they can charge whatever they need to people, especially passing taxes on and those kind of things, because it's an inelastic demand product. And I get the sense even firms like Starbucks are like that. I know people that will buy Starbucks no matter what. So, you know, there's some products where they can raise their prices when their cost of goods sold go up. So there's 2 things in there. Under financial leverage, I'm just going to look at relative debt to equity. Now I'm going to do that for the entire Russell. I'm using Russell 3000, not the S&P 500. So there's a little distortion there, but it's just to make sure I get all the companies in there. And Tamara and Vance, like I need to add your company in. So y'all might email me to remind me to do that. I mean, you're getting papers 2, 3, and 4 out of the way, but I need to get them in there. So if one of y'all send me an email, remind me. All right, so we're going to look at Wendy's. We'll look at Wendy's gross margin. Their gross margin standard deviation is a whopping 15.93%. That's pretty crazy. That ranks 89th. The stock market has gross margins should be pretty stable. I'm actually kind of shocked that Wendy's is like that, but the gross margins should be fairly stable. What was it for Mike? Let's see, I forgot what McDonald's was. 1704. 1708. Okay. Yeah, their margins are very volatile too. Now, McDonald's margins may not be what you expect because this is mainly franchising. I don't know if Wendy's is franchised or not. Anybody know? I don't know anyone that's open a Wendy's franchise.
They are franchised. My mom's friend owns the one in Vernon.
I wonder what percentage are franchised. So franchises might have pretty volatile gross margins. It's possible that that's the case here. But this is something that you can do. You saw what I just did. I changed to another company. So if you've got 3 or 4 major competitors, check and see if their gross margin is similar. It'd be really strange that your firm, let's try another one. I don't think Jack in the Box is 1476. I don't think Jack in the Box is franchised. Anybody know anybody that owns a Jack in the Box franchise? Wow, just really, really volatile. So for some reason, restaurants have really volatile margins. That seems unusual, but there's another company with negative net worth, so it kind of dominates this industry. Their net margin is actually below average. So Wendy's, the stock market's net margins is 1740. Wendy's is 1649. So it's kind of interesting. This gets back to what is in their cost of goods sold. And it could be an accounting thing. For your paper, you really want to focus in on the net margin. I put the gross margin in there more as a gee whiz kind of thing. So Wendy's as high gross margin fall, but slightly low average net margin fall. And the net margin means the most important one. Because if their gross margin really volatile, but they can somehow offset that somewhere else, then that's what the stock market's looking at in volatility. That's what they worry about. So this gets us below 1. This supports step 1. I don't see any major shifts there. But then we come to the crazy part, because we know this industry is just absolutely buying its stock back. So then we get the debt to equity. The typical stock is debt to equity is 56%. Wendy's is 883.68%. Does that sound high or low or average to you? Sounds a little high, doesn't it? It's because they're borrowing a lot of money? Probably not. It's because they're probably buying all their stock back. So very highly leveraged. So this is going to push the beta higher. Now, since this one's kind of close to 1, it's possible you might think, well, this is a 0.9 beta company, but with all that debt, I'm going to push them to 1.2. You could do that. That could be perfectly reasonable to do. All right, so it's a discussion. You'll notice this in the example papers. They go exactly through these 4 steps. All right. So let's do step 4. There's videos out there that do that. So here's Wendy's. I'm going to bring in McDonald's as well, so we have a comparison just to show you. So here's McDonald's Corporation. I click on historical data. I do max. They say 1966, but when you download it, they only take it to 1985. And we want monthly. You apply, you download, and just like that, you have McDonald's stock prices back to 1985. We're going to use the adjusted close because we don't want dividends to distort this. So all you need is the adjusted close. I'm going to come in and just make sure my years are lined up. So there's my S&P and Wendy's. I can take out October because October's not over yet. So I've got this September. It says September 1st, but it's actually September 30th. January 1st. So you can see my numbers. It's the adjusted price. So it's going to give us a pretty decent total return. So I got all my data. Move this stuff. I'll tell you what. Move this down here. Oops. So let's look at the history. All right. So the first thing we need is a holding period return, just like you calculated in 3013. Oh, I forgot how the center. All right, there we go. So what's the holding period return? It's ending market value divided by beginning market value minus 1. You can't do that for January because you don't have December 1985. So we just do ending market value divided by beginning market value minus 1. So the S&P 500 in February 1985 was up 0.86%. Wendy's was up 9%. McDonald's was up 5%. That's a great month for hamburgers. But the next month wasn't so great. Wendy's was down 21% and then up 11%. So it's all over the place. Then we're going to calculate their rolling betas. Oops. I'm going to do a 5-year rolling betas. How many months in 5 years? About 60. Is that right? Or exactly 60. So there's 60 months. All right. So we're going to do Wendy's and McDonald's. So Wendy's rolling beta. You remember what's the formula used for beta? And there's two formulas. It's covariance divided by, y'all tell me the rest of it. Someone knows it. Standard deviation of what? Remember, I said there's Wendy's risk is not in here. If Wendy's risk is not in here, beta is covariance divided by standard deviation of the market squared. Right, I know it's been like 12 years since you had statistics. All right, you remember the formula for covariance? I was talking to my other class. These are formulas you should know off the top of your head. Pretty important. So you can do that. That's a lot of work. Or you can just do slope of A, B, A, the stock, versus B, the market. You have to do it in that order. You have to put your stock first and then the market, or it doesn't work. So we're going to do that. We're going to do equal slope. We're going to find the return of my stock, which is Wendy's right there, comma, the market right there. So back in the 80s, Wendy's had a beta of 0.74 to the stock market. And McDonald's had a beta of 1.01. Now, would you expect Wendy's and Moody and McDonald's have similar betas? If they're both franchise, you probably would. If one is and one isn't, you might not be so much. Now, the last thing I'm going to do is that very last number. Because I just said, I'm calculating this the exact same way Yahoo Finance is. So McDonald's beta that I got for the last 5 years monthly is 0.59. What does Yahoo Finance say? They say 0.59. Is that pretty close? Pretty close. What about Wendy's? Wendy's is 0.89. What did I get? 0.88. Could it be a little different? Yeah, because I'm not sure where Yahoo Finance stops. It is October. It's possible they're using the October number. I don't. I leave October out. So that might. So you should be close though. If you get 0.88 and Yahoo Finance shows 1.73, you probably made a mistake somewhere. All right. So that's close enough. Get us what we need. So this last number that I'm calculating here is what Yahoo Finance is showing. All right. And then what I'm going to do is I'm going to graph the two of them, because I'm really, really interested. And you don't have to do companies, but I actually think it's pretty interesting to do that. First thing we notice is that Wendy's went crazy there for a while. I don't know what year that is. Let's put some years in here. See that? Yes. So that part that jumped up there, that goes from October 03 to August 08. So I'm going to actually take those out. All right. So you look at the last few years, McDonald's is consistently below Wendy's. Does that make sense? So you say they are franchised, but what percentage are they franchised? And which would have the higher beta, the franchise or the company owned? That would take some, you'd have to really think about that. Which would give you the higher number? Reformat this. Get rid of white space anytime you can, just so you can see the chart. But McDonald's is, as almost always, at least the last 10, 20 years, has always been consistently below Wendy's. McDonald's started off right around 1. Now, in the 2008 crisis, people look at that. So here's where people make mistakes on beta. Say, well, of course their beta went up. We had the 2008 crisis. What's wrong with that statement? If McDonald's beta went to 1.6 in the 2008 crisis, what else had to have happened? Because the beta of the stock market was what in 2008? You'll see the beta of the stock market. What did it do in 2008? The stock market, S&P 500 beta, what did it do in 2008? It was 1, right? If it was 1 and a stock went up to a beta 1.6, that was normally 0.8, what does that have to mean? Another stock had to drop dramatically. So you can't just look and say, well, obviously that's 2008. That doesn't work. Why would McDonald's suddenly be more sensitive to the economy in 2008? All right, so I'm gonna take Wendy's out because it's a little noisy. I added Wendy's so we could do the debt to equity. So if you look at Walmart, this is the chart this guy showed 20-something years ago. It was much more volatile for Merck. But what he said is, did McDonald's do something to make themselves much more cyclical? Did McDonald's for a few years say, you know what, we're selling hamburgers, but we're going to sell a few cars in the driveway where we're at it. So if you want to buy a car, we got to use car salesmen out in the back. Did they do that, or did they keep doing what they've always been doing? Why did suddenly in 2008 McDonald's become a high beta, really high beta stock, 1.6, huh?
Also, I mean, I've heard that they have investments in like real estate, so maybe that.
But did that change dramatically to it? Did they buy a lot of real estate in 08 and they sell out of it? Now he was showing Merck, and he was asking, you know, Merck was all over the place. Why was Merck a high beta, then a low beta, a high beta, and a low beta? Was Merck changing? No, Merck was doing essentially the same thing they'd always been doing. So what changed? Well, what changed was just the randomness of beta. There's a lot of random noise in here. It could be that McDonald's beta shot up in 08. It also could be that McDonald's reported really bad data on a day when the stock market fell 8%. And the beta calculation saw that as systematic risk when it really was just noise. So that can happen. That's just kind of the nature of beta. Beta doesn't know what's systematic and unsystematic. It's just kind of guessing at that based on the statistics. But it's perfectly possible that McDonald's just happens to report something major on a day when the market was off. And beta is going to say, wow, look at all that systematic risk. And say, no, we just fired our CEO. And we just happened to do it on a day when the market crashed. We didn't plan that. So McDonald's should be if capital asset pricing model is correct, McDonald's should be a fairly straight line. What do you think banks betas look like in 08? If I put bank stocks in here, Citibank, if I did Citibank, what would their 2008 look like? Be off the charts. Why? Because they were in the center of they were what were causing the market to sell off. What would tech stock betas look like in 2000? Be off the charts. So it's very unstable. Depends on what the market's focused on. Right now, the market's focused on inflation, where there's some companies that may be very defensive, but they're more sensitive to inflation. You know, you see firms like General Mills and Kellogg's, boy, they're trying to get wheat out of Ukraine. Yeah, they can be right in the middle of the storm just because that's what's going on right now. So beta has some problems along those lines. If you look at the median, what you see there is the tale of two companies, don't you? You got pre-2009 and post-2009. It could just be McDonald's is much larger today than it was back then. I don't think that's so much true because they were pretty big back in '89. But if you did a Walmart back to '70s, you would see this. Walmart used to be a small regional kind of player. So as stocks get bigger, their betas come down. We know that just from the theory that small cap stocks have a risk premium. So it could just be, and that's one of the things you'll see in Bloomberg. They have something called the adjusted beta, and all that is the assumptions that betas get closer to 1 over time. Just a bottom line assumption. But so which of these do you use? So what does Yahoo Finance say to use? That point right there. That looks like a reasonable point, doesn't it? But is that the right point to use? What if we were sitting right here? And you go to Yahoo Finance? You would never buy McDonald's stock, would you? Yeah, McDonald's, high cyclical company. Boy, it's the first thing people cut out of their budgets if they're worried about losing their jobs. I was going to buy a car and get McDonald's. I think I'm just going to buy the car and go home. Probably not many people that say that. That's not a very logical thing to say. So doesn't make sense. No way that makes sense. I also don't think this makes sense. There's no way McDonald's is a 0.3 beta. If you use this, if you're sitting at Yahoo Finance right here, you may be putting your whole portfolio in McDonald's. They're going to look really, really cheap. So we've got an issue here. So the question is, do we throw it out entirely, or do we come up with a number we think is reasonable? And so that's my approach. So you put this into your paper. I also encourage students, maybe put the 90th percentile and the 10th percentile in there so you can just see kind of the range. That's pretty easy to do. Sorry. So 90% of the time, they've been above 0.42, and 90% of the time, they've been below 1.11. Now, do you just pick the midpoint of those two? I don't know if this is going to work or not. Probably not. Oh, my word, I messed that up, didn't I? Because what's the problem we have with McDonald's? It looks like two different companies, doesn't it? If I were doing McDonald's, I would probably limit my data to the more recent time because they're so different. So if I did the 90%, but I just started right here, I would have the median would be there and the 90th, it'd be very, very different. So two very, very different companies. You could put this chart into your paper and then do a separate chart where you just do it from like 2010 maybe, and then look at the data. Then you have some discussion on why do you think it changed? See? Who knows why it's changed? Maybe just McDonald's has gotten so saturated. I can't think of any other thing that McDonald's has done. The one big thing McDonald's has done is a major shift from company-owned stores to franchises. And I have to think why that might reduce beta dramatically. I could probably come up with a rationale. I would just be making up a story to make it fit the chart. But if I really had to think about why a franchisor would be less volatile than an actual company owned. I mean, it's much cooler to be a franchisor because you don't have to do much. You just collect royalty checks. So it seems a lot easier. Seems like you'd have more fixed costs because you just have a bunch of high paid staff sitting around waiting for the checks. You probably have some salespeople out there. So who knows? Maybe that's the part of it. I think of McDonald's is closer to a one kind of beta company, but I look at this and say, well, maybe not then. They're highly levered because they have no net worth. So that would certainly push it up. So that's essentially what you're doing with your beta. So you do the rolling, you look at the median, the 90th and 10th. And then the most important thing is put all of this together. What most students do is they do the 4 steps. They build a historical and they do their entire final analysis entirely off the historical. They ignore everything they did before. So how do you get yourself, remember what you did on Porter, how did it get you to get Porters in your final? How about a summary table? Would that maybe work? Here's what revenue sensitivity says. This is defensive cyclical. Here's what the operating leverage is, the financial leverage. History suggests this. My final recommendation is that. All right. The other thing is you're going to run scenarios. I want base, best, and worst case. 3 scenarios. Best case is which beta, the highest or the lowest? Lowest. I define best case as the highest price. So your best case is your lowest beta. Your worst case is your highest beta. And you'll notice that in the prior student papers. So that really is paper 6. Once you get through all of this here, that really is paper 6. Y'all want me to save this somewhere? It's probably not much different what's in the rubric, but so it seems ridiculous. Paper 6, you're just trying to get 3 numbers. And one of them's really easy now. It used to be hard. 2 of them are a little more work, but the betas, I don't think it's all that much work. It's really just looking at your company and thinking about it and put the numbers down. Now, if you took my investment class, which is how many of you had my investment class? So you've already written this paper, right? So you can plagiarize yourself if you like. If you're doing a different company, you can't. So how many of you took my investment class and are doing the same company you did in that class? Is that anybody? So you can plagiarize your risk-free, but even the risk-free you can't plagiarize it because interest rates were so much lower back then. So you can't. So if I pull it up and it tells me that there was 80% plagiarism, I'll click and it'll say student paper. I'll click on it and have your name. You can plagiarize your own paper. And I won't go back to the investment class and make sure you didn't plagiarize someone from there. I did that back then. So you can plagiarize your own paper. And I do see that a lot in this paper. All right, what questions do you have on this? Now, in reality, you don't see a lot of this in research papers. So those of you doing the research challenge, most teams don't talk about beta, or if they do, it's really fast, or they just say this is our beta. I don't think your team, Colin, even brought it up. And y'all did a lot of work on it. You had to come up with it, but you don't really. It might have been in your football chart and all that, but yeah, it's
Plus you're restricted, so we really.
yeah, restricted on times, and they don't generally ask that question. So this paper is almost more of making sure you got this theory down before you graduate, because it's a really critical theory. But when you write a research report, this is one paper that's probably going to be much, much shorter than you would actually do in practice. The beta is probably the most important part, because you're not really going to justify your market risk premium in a paper like this. You're going to be focusing on your companies. So what beta did you use? It would be somewhat critical. So if you look at prior papers, they will help you quite a bit here if you're at all worried about kind of formatting this. Well, I don't know which one they use. We were talking about Microsoft earlier. Someone was asking how many pages was it? So what is it? 134. What did I guess? 130? I got pretty close. He uses beta 25 times in this paper. All right, discount rate. The one thing I don't like is he doesn't do full justify. My favorite is full justify. My second favorite is not full justified. My least favorite is sometimes full justified, sometimes not. That one I really dislike because it just looks messy. But he's at least consistent. In projecting Microsoft's valuation discount rate for Microsoft, a lot of debt. Now Microsoft, yeah, has a lot of debt, but they also have a tremendous amount of cash. Like a company I was looking at the other day, is like their interest expense was negative and they had debt. Yeah, they had $300 million of debt and they had $900 million in cash. So yeah, they make more interest than they pay in interest. Microsoft is one of those kind of companies. To arrive at the discount rate, I'll apply CAPM. I think that's about all he talks about CAPM. Now he talked a lot more about risk-free rate than you probably will need to, but that's because the risk-free rate was it was at 235 back then. You're up to 4, over 4 now. Tomorrow's probably going to be back above 4 again. I mean, back higher. Today was an incredible rally for bonds. I don't know if y'all noticed that. Pretty crazy. So yeah, down 13 bips. That's like a 2 standard deviation event. So there's a big rally in bonds. But I was looking at this bond fund and it's down 3% overnight. So maybe the rally will reverse tomorrow. We'll see. I bought this bond fund and then like, wow, smart decision. We'll see tomorrow if it was such a smart decision. I'm slowly rolling my beta out, my duration out. So, all right. Where is he? There he is. Now he started off with his final answer, risk-free rate of 392, market return, market risk premium, betas, 3 betas. 0.83 seems awfully low for Microsoft, but that's what he's using. And there's his final. So he started off with a summary. That's fine. Kind of say where we're going. Well, he does have more on the 10-year. He put a graph in on the 10-year. That's perfectly fine to do. You would be showing where we're getting back up to these normal levels. So that would be an interesting chart. But this year by itself would really stand out on this chart. Be kind of like there, wouldn't it? Even more than that. This is what. No, be real comparable to that. And let's say we went from 0.5. So this is before the 0.5. We went from 0.5 to 4. So no, it's going to be more comparable to that. So 350 basis points. Yeah, it's going to stand out on your chart. No question. Yeah, he went on more and more. This don't get intimidated by his paper. He went a little overboard because of what was going on. Yeah, there he has more on the 10-year. You can see why his paper is 134 pages long. So yeah, he's still talking about the 10-year. All right, then he gets to the market. He actually went out and looked at some surveys. So he did quite a bit there. So yeah, his paper, yeah, this is not a good paper to show because it's scary to death. Maybe Luke's paper will be there. Let's find a little more normal one. Look at Costco last year because I know Bond followed it pretty closely. Most people don't struggle on paper 6. It tends to be a more straightforward paper. Now he defines it. I would not put that into your paper. Beta is, you know, you don't need, we know what beta is. You're writing this to professionals in the industry. So you don't really need a lot of definitions here. So again, he spends a lot of time on the risk-free rate. Probably about twice or 3 times as much as you do. He put in the recessions in here. There you can definitely see, I mean, it's pretty amazing. It looks like a big move, doesn't it? And then so we went from here to here very rapidly. Now I think there's a little sideways motion in 2021, but it's just going to shoot up. So it's definitely going to stand out as one of the biggest, sharpest. I mean, I remember 94. 94 to us was an incredible bond market. And you're going to notice this one's even bigger. So yeah, the graph would be good for this part of the paper. Market risk premium. He gives a little history on that. You don't need to do that. You can if you want to. We talked a bit about those different approaches. I think he copied some of this from the JP Morgan. So he's going to use the implied approach. So you don't have to write justifying why you're using your implied approach. You can just use it. He talks about the dividend yield plus the buyback and those different things. So you can see he's using the graph I showed y'all. Here he has a table that shows where he got his expected earnings growth and his finest market risk premium. So he's expecting stocks to make 7.3% minus the risk-free rate and uses 568. And on beta, that should look really familiar. Is it defensive or cyclical? I call that revenue sensitivity, operating leverage, financial leverage. He used the chart. Look what he did though. He brought in 4 companies to compare on net margin, standard deviation, and debt to equity. He did the rolling beta. If you notice what he did is he put his 90% and 10% just from this last period. Costco probably does fit into the small company becoming a big company for this period of time, because Costco has really grown quite dramatically. So it probably would have been a small cap back here and probably is a large cap here. So that would make some sense. And then he just has his final beta. All right, so yeah, the papers I'm showing you are longer than what you need to do, but I bet the best papers out there, there's some papers that are perfectly fine that don't have to be that lengthy. This is the paper you could probably sit down and write in 3 to 4 hours and have a pretty good draft without too much trouble, especially if you're in my investment class. All right, do y'all have questions on, do not say, what did I change? I didn't change anything. I'll put this out there. I don't know what I call it. I'll just put it on our class notes and just scratch class notes from October 25th on beta or something like that. All right, so we'll stop it there. All right, let's get started. Okay, so you have papers this weekend. If you need a Zoom or something Friday evening or Saturday afternoon or Sunday afternoon, let me know, set something up, get caught up. We still have a couple of people on paper 1. You got to get paper 1 done like ASAP. And then definitely get 2 and 3 done. If you have struggles on 4, we can set up time after this weekend and get 4 worked on. So to Ashley's point, and I don't know who the other person is. So Ashley, I thought about rigging the numbers, but here's what I would do if I were you. Get rid of that chart 15. Get rid of 16. On 16, what you'll do is just talk to the fact that their net worth went negative, so you can't talk about that. You might reference back to their debt to EBITDA chart. And what I would do instead of chart 15, if you go into the data for graph building and where the return on equity is, instead make it return on capital. And that actually starts in cell BA. If you change that to BA, you have return on capital. Not return on equity, return on total capital. And so then this becomes return on invested capital. And you can just talk to that line. All right. But I was thinking about adding back to treasury stock. It's really not a good answer. And if someone were to look at your paper and see that's what you did, they would probably you know, you could tell them the professor did it, but they're not gonna, this doesn't make sense to do that. So return on invested capital is not radically different than ATL times net margin. It's almost the exact same thing, but at least you have a return on capital chart in the paper, and then you just can't talk to that. So if you wanted to bring in the EBIT, you know, just reference back to the EBIT, debt to EBIT chart, and just, you know, like, we don't have equity, so I can't compare their leverage to their equity, but looking back at their debt levels, they were a little high, a little low, whatever, just repeat that and you'll be fine. All right. It makes sense. And whoever else the other negative person was. All right. So yeah, feel free to email me. This weekend's not too bad because you're the only paper I had to grade. Last weekend was killer. I had 2 classes to grade, including my life insurance class, which was a really long paper. I just barely got theirs done last night. So, but y'all's the only one to have this weekend. This is a pretty small class, so it doesn't, not too difficult. So if you want to set up Zooms and go through things. The nice thing about papers 5 and 6 is it's stuff you've been doing already, undergraduates. So it's just a matter of applying it. I do have a video that I've created for 5 and 6 that I use in some of my classes. It doesn't really get you paper 5 and 6, but it gets you all the data. So you at least get all the data and you just write about it. So the stock valuation, what you have to do in stock valuation is, number one thing is come up with your growth rates. That's probably the most important thing of all. And then valuations. So you need to do at least 3 valuations, and you're going to run scenarios. So you end up with probably 9. So you have 3 different models, and then you'll run 3 scenarios for each one. So you'll end up with 9. Now, does 9 seem excessive? I should bring in the CFA's example. I think I counted they had like 150 something scenarios. So 9 doesn't seem all that excessive. I've had people say, well, your ranges are so wide, man, you're like from $50 to $170. Well, if you look at the CFA example, it's even wider than that. It's extremely wide. So that shouldn't bother you. Put in the numbers you think are there. So when you're running scenarios, I think it's the truth. I think when you're looking at a firm like Meta, could you be off by 25%? Yeah, you could have been off 25% yesterday and been right today. So, you know, these stocks are really hard to value, and who knows what's going to happen next 200 years, which is what you have to do. So this paper is all about growth rates and then applying it to models and coming up with valuations. So how do you get growth rates? So there's 2 growth rates that you need. One is the terminal growth rate. You've already done that. That's going to be tied. It's going to be tied to your what you did in paper, the previous paper. When you're coming up with how fast the economy growing, you're going to tie that to the economy. Doesn't have to be the exact same number. So if I were doing Walmart, if I think the economy is going to grow 5%, I'd probably have Walmart a little below that, 4 to 4.5%, because it's a big company. It's pretty well saturated. For the economy grow at 5. The big companies are going to grow more slowly than the brand new companies that don't exist yet. They're going to get you that higher growth. So I would think any big company is going to grow more slowly than the economy. But you already have that number. I would not run scenarios on that number. So just have one number there. Well, we'll talk about that. Well, yeah, you will have numbers there. Sorry, I'm thinking the age. So that you have to tie. We've already talked through that. What do you think the economy is going to be? So the big one is near-term growth. Now I'm trying to think some of your firms, if you're at terminal growth, then you just got to start pretending. So if I think Walmart's terminal growth is 4%, and I also think their near-term growth is 4%, then I'm probably going to say 4.2% and 4, just so I have 2 numbers. All right. So you kind of have to rig it. So if I'm doing Camel Soup, Walmart, some of these firms, Coca-Cola, one, Carlos, that we hear a little bit later, those firms may be at their terminal growth, and in which case, you know, it's got to make something up. So go back to your Porters. Was this an industry that looked strong on Porters or it looked weak on Porters? So start with the industry. How fast is this industry growing? You ended up with your final conclusion on paper 1 of, is this industry average, below average, above average growth? So So like Tamara, you've got a whole group of new cars that got to be built. Oh, you're not doing cars, that's vans. So is it possible EVs are going to give them a whole new growth rate? You know, California says you can't buy gas cars anymore. Tamara, you might be China versus the US or something like that. You know, whatever argument you can make that is going to be different. It can be the case of like a good example is Facebook and Google, where you think long-term they're going to get back, but we're at this adjustment period where they're going to be actually negative growth. Could be an Exxon, no one's doing Exxon, but you could have an Exxon that says, man, oil prices are really high levels. I'm going to have negative growth the next 3 years to get that back down. You know, there's all different arguments you can make. But what is your industry like? Where's the strength in your industry? Then look back at your papers 3, 4, and 5. Remember, you just did a forecast. I guess it's two papers. Sorry, I should never change paper page numbers. 2, 3, and 4. You just did a forecast in paper 4. You can't have 10% growth in paper 4 and then you're going to use 2% in paper 5. That doesn't make sense. So there should be some consistency there. Remember what your asset and turnover and margins are, because that's the most important part of growth. Remember the sustainable growth formula, which gets you back to return on equity, and how's that looking? So go back and look at those numbers. What's the trend? Are they improving? Are they getting worse? That can give you some help. Is your company radically different from the industry? Are they doing something very, very different than everybody else? So like Anthony, in your case, AVs is a disaster for your company. So how are you going to handle that? You're going to have them go to zero, shrink, go out of business? Are they going to get into liquefied natural gas and get more into heating houses? You're going to have to figure that out. You know, do you think Valero is going to exist in 50 years? And if they are, what are they going to be selling? Are they going to be selling gasoline? So, you know, you take the firm like Western Union. Western Union was Telegraph. How many of y'all use Telegraph anymore? Not very much, but does Western Union exist?
Yeah.
Yeah, what are they now? They're now a payment system. Different company. Their history means nothing. So, you know, is it possible Valero is going to be selling flowers online in 50 years? Who knows? But you got to make those decisions. Be bold. You're actually better off bold at interview than you are trying to be kind of nice and even. So, you know, Anthony going in, well, don't interview with Valero, but somebody else say, you know, I don't think Valero is going to exist in 50 years. I don't see any way they're going to reinvent this business. What they're really, really good at, we don't need anymore. That's a pretty bold statement. And your paper gives you a problem because you have a firm that you're going to take out of business. So if your company's growing faster than the industry, then whose market share are they taking out? You need to somewhat think of that. So if you can think Nike's going to grow faster, industry's going to grow 6%, Nike's going to grow 10%. Why is that? Whom are you taking out? Now, it could be, well, you could say, well, they're selling to senior citizens and emerging markets, but the whole industry should benefit from that. So I'm talking about that's in your industry numbers. So why are they growing faster than the industry? That usually means they're taking market share from a competitor. That's exactly what we did at USAA. I can just remember our CEO had a requirement that our market share had to increase every single year. But the conversation never had was from whom? Whom are we going to steal this market share from? So, oh, Navy Federal Credit. Okay, well, are they just going to sit around while we take their market share? Or are they going to have some new blitz? They're going to, you know, most firms don't say, oh, we're losing market share at the USAA. Too bad. I guess we'll shrink. That's usually not the response. So why are they getting better? Is there someone going out of business? You know, I don't know with Best Buy when Circuit City and the other guys. Oh, who is the other guy? I can't remember. No, I'm thinking of the mall company. Can't remember. They used to make Tandies. But anyway, when those firms go under, does that help Best Buy? So you could say some of these firms are going to go under. I know. So think through that, but think about the market share implications. If you have in paper 2 some market share charts, you might reference back to them and say, hey, this firm isn't growing. So a good example thing in insurance, USA has been fairly flat on auto insurance, but Progressive and Geico have been taking over the industry. Yeah, it's what are you going to do different? So USA open up to the enlisted market. You can have those kind of arguments, but you have to have it. It has to make sense. You can't have the whole industry growing 20%, you're growing 30%, and you're not explaining how that's happening. You can definitely look at analyst expectations for your companies. So Merchant Online has analyst reports. Bloomberg, you can go to Bloomberg and type EE for earnings estimates and see what they say. They have earnings estimates and they have revenue estimates and they have EBITDA estimates. So I told you about that for paper 4. You can think about that again. So a good example, you know, Luke, you're doing Costco. I don't know if you looked at the Bloomberg estimates for Costco. They were ridiculous last time I looked. This is way too, it's like COVID kept going. Like we had a COVID every year or something. So I don't know if they've come back down on those estimates, but you can certainly use that as your expectation. Another way to use analyst expectations is the PEG ratio. So the PEG ratio is the forward PE ratio divided by the next 5 years earnings growth. So it gives you a number. So here's Apple. Apple reported today, and it doesn't seem like they're crashing like everybody else. So if you go under statistics, they'll give you the PEG ratio. Now, I don't yet understand what Yahoo Finance is doing with this current, because the PEG ratio especially can really look wild. I've seen sometimes where it goes like from 2 to 15 or something. So I'm not sure exactly what they're doing. So I recommend use their last quarter number. It's strange. I'm not really sure what to do here, but let's do the 2.38. And then we'll do their forward PE. Forward PE is 21.55. So the expected growth, you just take the forward PE divided by the PEG. And if you want to, you know, divide by 100 because it's not in percent. So that gives you 9.05. Now, does that make sense? Well, let's look and see. Always like, just kind of curious to just see what that actually means. So I'm going to bring in their basic earnings per share. Looks pretty strong to me. Looks a lot better than 9%. So last year grew 71%. Is that correct? And 10%. Do I have Apple or did I pull the wrong company in? So went from 331 to 567. That's a lot more. Look at their revenues. My word. Pretty impressive, isn't it? So look at the recent history. 9% doesn't seem too radical. What about Costco? So Costco's PEG ratio is 359. PE ratio is still really high, isn't it? 36.23. I don't understand that at all. And so that gives you a growth rate faster than Apple. How many of y'all think Costco is going to grow faster than Apple? Which is, if I say you meet me in 5 years, I'll give you $2 million. How many of y'all would bet Costco's growth would be higher than Apple's? You have to pay me $5 million if you're wrong, so you might not take the bet. But so yeah, that's kind of interesting. what about a firm like Meta? They still have positive earnings, so they should have a PEG ratio. Look at that PEG ratio. Doesn't that look really, really low? And their PE ratio, oh my word. Their PE ratio looks like Macy's now. It's really, their forward PE is still pretty high, but their current PE, yeah, we should, well, that's the forward. Yeah, we should use their actual PE ratio. These are old numbers. So 1131. So 7%. But their actual PE, I can't give you their actual forward PE right now after today's earnings, but their actual PE ratio is 7.68. So 7.68. I mean, they're saying Meta's at their terminal growth. Right, which is higher, Meta or Macy's? That would be interesting, wouldn't it? 768. Nope, they're still higher than Macy's, so that's not saying much. This is pretty amazing, isn't it? Because you buy Macy's stock and they just earn what they're earning today or next 4 years, or get all your money back in 4 years. You do that with Amazon. Amazon sold off a bunch today, so what's their PE ratio? Did it fall much? 99. I guess it hasn't sold off yet, has it? So it's tomorrow it's going to sell off. So even if it drops 12%, it's still going to be a really high. They'll be in the 70s, so it's still going to be a really high PE. So what does that imply for their growth? We can't adjust it for their earnings, unfortunately. But really, really high PEG ratio, 401, but even higher PE ratio. So 64 over that, you're talking 15%, 16% growth rate over the next 5 years. So you can certainly use that. That's probably not much different than going to Bloomberg and using the EE function, but you can certainly use that to give you some sense of what's going on. Let's look at NVIDIA. I'm curious what the market's thinking on some of these stocks. PEG of 2, PE of 34. So that's a pretty heavy growth rate, isn't it? That's what, about 11% maybe? I can't do that in my head. 3401. And whatever the other number was, 265. What did I do wrong? That's not right, is it? Plus that divided by that. Divided by 100. Is that right? 12 point. So 12 point. Let's see, the PEG ratio is 34.01 divided by 2.65. Divided by 12.83. 265. All right, so that's higher. My math wasn't good. All right, so 1283. That's a pretty hefty growth rate. Seems pretty confident. What's the next thing you notice with it? Their trailing PE is much higher than their forward PE, so they're expecting earnings to bounce back quite dramatically. Have their earnings fallen dramatically here recently? Doesn't look like it. Boy, that seems really rosy. Do I have the right company? Is that what you're seeing? That rosy kind of projection?
Yeah.
Is that coming from AI or something? I thought Bitcoin was going to really crush them, but maybe not.
Yeah, I mean, they're getting a little crushed by like the Ethereum merge and stuff, but there's still AV and AI and a lot of other.
And EV too, probably.
EV and
Oh, that's interesting.
cloud computing too.
Wow. All right, so the market's positive on a stock that's come down kind of pretty good amount, 60 something percent. Yeah, the stock's coming. Yeah, it sounds like a good stock to buy if the market's correct on that. So it gives you some sense of what's going on. You could also do this with your key competitors to get some sense of what does the market think growth rates are, is to kind of get a range of what's going on. Same thing with the EE. So if you got 3 or 4 main competitors, get the PEG ratio, get Bloomberg, maybe do a table and just see these are growth rates we're seeing are out there consistently with these companies. They range from 8% to 10%. Those kind of things that try to help you with assumptions. The historical perspective, well, like we just did, can be really, really good. Pull in your EPS, annual EPSs for several quarters and just calculate growth rates and just see what they are. And then see if it makes, if a firm that's the highest they've ever grown is 6% and you're projecting 9%, you really have some explaining to do in that part of the formula. I have a video that shows you how to do that, but and then the sustainable growth formula. Let's try that with what company did I do? Apple. Let's try that with Apple. Or let's try it with Costco since no one's doing Apple. So you have ROE, you have the payout ratio, you have the retention, and you have sustainable growth. I have to admit, when I was in college, this is all we used. There was actually a report we used that they just did this calculation and we valued our stocks. It used to take us like 3 minutes to do paper 6 or 5, whatever it is now. So, I mean, literally, this is what we did. Pretty simple. So let's go to Costco, go to their statistics and the return on equity. I'm sorry, yeah. Where is the return on equity now? Oh, down here, sorry. Okay, return on equity. Well, here's their dividend payout, 25.72%. So what's their retention? One minus that, 74%. So the theory is you can't grow if you're paying out all your you're paying out your earnings. So the more you retain, the faster you can grow. So then we just need to find return on equity. Here it is right here, return on equity, 30.55. That sounds like a really good return on equity. So what's their growth rate? Return on equity times retention, 22%. Now, what's the problem with that? Well, this might be a really inflated return on equity, maybe because of COVID. So what I tend to do is I prefer to normalize this. How do you normalize it? You could do the average or median last 5 years. That might work well. I mean, I'm thinking 30% is a pretty good number for them. I don't know what you had in your history, what your chart 15 showed, but assuming 30% is a pretty high number for them, that you're not going to assume they're going to keep doing that going forward. And the other issue you have with Costco is the payout ratio, because sometimes it's like 300%. So how do you handle that? So it's a little bit tricky. So on the payout ratio with Walmart, it's fairly simple because it's a fairly consistent number. For Costco, maybe you have to go back the last 10 years and divide the last 10 years by their earnings the last 10 years and just see what those big payouts do. I don't know, somehow normalize that. If you need to, you may not need to. And that gives you a growth rate. That seems awfully high for Costco, especially since what's happened last year is probably a really, really good year. For a firm like Meta, their history probably looks still pretty good, I would think. Their ROE is still pretty strong, and their payout is probably 0. So, that gives you a really easy growth rate. It's just their ROE. But obviously, the market doesn't think that. So you're at this junction that particular approach doesn't make any sense. But that's the traditional approach. There's no source for future growth. I do have students email me, where do I get my future growth? It's like, your guess is as good as, well, your guess should be better than mine because you're actually doing this analysis. But ultimately, it's a forecast from paper 4, and it's subjective. remember I should have put this under sustainable growth. On sustainable growth, you are talking economic moats there. If you think a firm's going to grow fast, what is that economic moat that they have that's sustainable? They can keep the competition out. So NVIDIA is their knowledge base, and their Salesforce. For Valero, it's their plants, their refineries. What do they have that can't be replicated that easily that should allow them to sustain growth at a certain level? And you're doing Monster, right? Yeah. So I'm curious. Monster's been killing it, haven't they? Did people drink more of it during COVID or not?
They just, they're less expensive, it's just like for the sponsorships. It's the same. You know, still going out there.
Where do they mainly sell? Is it
In the
in
US. What is it?
where?
In the-
Grocery stores or
It's to distributors, so if they have a deal with Coca-Cola.
okay?
Well, it's just there.
So I wonder if it's because they don't sell in restaurants, I would assume. So it's grocery stores, convenience stores, vending machines. Where do y'all get y'all's Monsters? Vending machines 90% of the time, or the convenience store, gas stations? I see them here in the vending machines. It's pretty interesting. They're really expensive, aren't they? They kind of stand out as being. And then they have these new drinks that, and first time in my life, buy a drink where I have a warning on the back. It's like, be careful, you're going to die. You drink this. But so here you have firm, his return on equity, 19%, probably no payout, I would assume. So 19% looks pretty good. Their earnings per share. I wonder on Apple if I didn't have quarterly before. Is that what my problem was? Were y'all paying attention? So the earnings had a huge jump there. Is that COVID? And then it's been flat this last year. But yeah, I mean, you could certainly make an argument for Monster to have really strong growth next few years. The industry part, people are switching to this away from sodas. I assume that's still happening. And is Monster the largest or are they second largest?
They're second under it.
Red Bull. Okay, so Red Bull and Monster, are they gaining on Red Bull or about the same?
That's the same, but always been just.
So their moat is their brand name. Is there any difference between Red Bull and Monster? Energy, caffeine, taste?
So they're able to.
Okay,
like,
distribute.
use them.
Distributors. So who does Red Bull? Red Bull is itself or
Yeah, they're just their own.
okay. Yeah, so having Coke behind you, that probably helps. So those are the kind of things you're thinking about. What case can I make for this company having higher than expected growth? Especially with higher than expected growth. That's pretty important. It's hard to keep, I mean, just ask Meta, it's hard to keep high growth going for a sustainable long period of time. 10 years, you go back, people say, what about Microsoft? What about Intel? What about Amazon? Yeah, there's a few companies that sustained really high growth for about 10 years. That's 10 companies out of like 40,000 or 50,000 companies. There aren't that many companies that sustain 30-40% growth for long periods of time. It's just really hard to do. Obviously, a small company starting off, yeah, they're gonna have ridiculous growth there for a while, but eventually you just can't do it anymore. So this is a discussion. I'll look at some paper. We'll show you probably next class some of the papers and what they did. So long term, I do want to do base, best, and worst case. On short term, I'm going to show you how to do base, best, and worst case. It gets a little challenging because now you've got, too many scenarios. I'm going to show you how to do it though with a data table, so you can get a lot more scenarios in. So I'll show you how to do that. And then the hardest part for most people is the timing. So let's say Monster is going to grow like 12%. For how much longer? All right, so if I were Dominic, probably what I do, let's do Monster. So you probably get these questions in interviews now, right? How many piano tuners are in the United States? Have y'all gotten that question? Someone had one the other day. How many barbers are there in the United States? Have y'all gotten those questions in an interview? Huh?
They can't even get interviews.
Well, I mean, I think you got an interview. You should be able to get one. Yeah, they're firms are hiring. You should be interviewing right now. This is the most important thing. But those are the questions they're asking. They don't care how many barbers are in the United States. They don't care how many pianists are. They want to know, can you do the math? They say, okay, there's about 400 million people in the United States. There's probably 3 people in each house. So let's say there's 150 households. Let's say 10% of houses have a piano. They tune. That's what you're going through. Then you also have churches and bars that have pianos. That's what they don't care if you have the right answer. You could be off by a factor of 2 or 3. They're looking for your logic, right? The same thing goes here. So what is the global market for bottled drinks? What is that market? You can do it in people times drinks per year. How many people in the world drink bottled drinks? So there's 7 billion people in the world. How many of them drink bottled drinks? Now you could go out and get emerging countries and say they don't drink it, but I see people in Costa Rica, in the poorest part of Costa Rica, they do buy bottled drinks. So you start with that. What percentage are energy drinks? Today, what is that going to be max? See where you're going. You said that and do the math. You can also go growth in population. That's a big part of what you're doing as well. So you're essentially trying to find some logical way to come up with a ballpark figure of what that growth rate can be. At some point, we talked about this before, at some point, Monster's growth rate is going to be population plus inflation. You can't do any more than that. Even if you say people are going to drink more energy drinks, I mean, how many can you drink in a day? I mean, at some point, there's no way to sell anymore. You know, they've been to Mars. There's nobody on Mars. I don't know how farther we're going to get in the next 50 years. It's probably no one else to sell this to. World population is probably going to hit about 10 billion and just stop. And once you get, you can't get everybody in the world is not going to drink energy drinks. So you're always going to have some cap on that. So ultimately you get to that point. But you're going to try to work up to that point. That's kind of like the Damodaran and the joke he tells. I think I showed y'all before the paper he looked at from Netflix, and he to get the guy's numbers and said, you've got more than the entire world population using Netflix. That's just not going to happen. It's not possible. So you got to make sure you're not going too far with your growth rates. And that's real common with college students. They get so excited about the firm, and then when you look at the numbers, it's like you got 42 billion people using your product. They're not going to be 42 billion people in the planet. I think that was the problem we had with EVs. I remember reading an article, I didn't actually check their math, but an article said they're pricing EVs as if every EV company is going to be 100% of the market. It's probably not going to happen. It's probably not possible. So, that's the kind of things you do. So make sure you're watching for those natural limits and making sure you don't hit them, because if you hit them, you've gone too far. All right. So Luke, with Costco, that's why I really like number of people per Costco. So in Texas, maybe it's 250,000. In California, maybe it's 3 million. Say, okay, are they saturated in Texas, or are they good more? You're not going to get to one person per Costco, but what could you get to? And what's the U.S. population? And will they leave the U.S.? I'd actually, go the whole way. How far could they go? Could they go in South America and those kind of things? Try to get a sense of what's the largest this thing could be, and you can just logically think through that so you don't go too far with your growth rates. So what are those natural limits? Now, For Valero, you know, I'm gonna say gas cars, miles driven. Those kind of things I'm looking at. Miles per gallon, that's changing too. Even if we stick with gas cars, miles per gallon is getting better. And go through all of that, and then you could over time percentage gas versus electric. What do you think that's going to be? Do you think gas cars will ever get to 0%? Or a government come to the point that they couldn't do that in Costa Rica because they drive their cars 40, 50 years. They don't even buy new cars in Costa Rica because the mechanics don't know what to do with the computers. So they buy 10, and it's crazy. They're selling these 15, 20-year-old cars for like $40,000. It's insanity. It's like Alex, he bought this SUV. It's like, how much you pay for it? It's like, oh, you could buy that for like $5,000. That's just ridiculous. But they love these cars. They don't have computers in them.
You know, like, I was actually like, taking a marketing class one time, and the professor said that he had a Volkswagen, and the car lasted him like 700,000 miles, and I was like, wow. So
Yeah, 700,000. In Costa Rica, I think, yeah. There's not too many cars you make that far. He probably rebuilt the entire car is probably all different parts than he originally purchased.
So I told him like 700,000 miles, and he said like, oh yeah. So then I told him like, why didn't you just told Volkswagen that your car like lasted for so long, and like he laughed and said like, oh, you know that in like Eastern Europe, people drive so slow, and like they take so much like good care of their cars that their cars last for like a million miles.
Yeah, a friend of mine just got back from Cuba, and it's great to go to Cuba. You get these wonderful pictures of cars from the 50s,
Yeah.
but they're not antique cars. They're they can't get new cars from the US. So
The Valero's, new renewable diesel in a diesel vehicle produces 60% less emissions than a diesel.
would that be allowed in California?
Not with Gavin Newsom, but, you know, it's a lot though, that they're showing that even the creation of the battery and the vehicle produces a lot more emissions, and then the renewable diesel over time at 1,000,000 miles, is 60% more. So
Yeah.
over time, it's like that EV is not.
So you're gonna have to face that, right? You can't do a paper on Valero and not address that. So when you get to your growth rate, that's gonna be a big part of your discussion. Now, it probably was in paper 4 as well, where you're doing your forecast. But here you've got to get some sense of what's going on. Are you gonna actually take them to 0? Or are you gonna, give them, say, hey, we're always gonna have at least 30% gas cars because of X, whatever. And miles driven today is this, only 5% of it's EV. In a few years, it'll be 70%, but we have some overs, whatever. Sit down and just make your best guesses. If you can get data to support that, do that as well, but you want to have some sense of what's going on as a natural limit for your company. I don't know if any of you, some of y'all have interesting companies where it's kind of hard to, you got to think about who's buying your product, or what does your product go into. The demographics of it. If you mainly sell to 20-year-olds, how many 20-year-olds will there be? Those kind of things. You got to kind of get some sense of what makes sense. Don't just plug a 12% growth rate on for 20 years and say that seems reasonable, because those kind of growth rates, you get the points where you have something that can't possibly exist. And you don't want to have an assumption that's not mathematically possible. All right, so the timing then tells you, when do you get to that natural limit? When can you get to where you just can't grow anymore? And then just come up with a number and justify it. There's no way for me to say you're wrong. All I can do is grade whether you have a rational explanation for it. No one can say it can't possibly be 10 years. It's got to be 8 years or less. And there's no one can possibly say that.
Have you heard of the employee supply problem with Amazon, how they've exhausted all the US labor force?
Yeah, labor could be an issue as well. You think they're gonna, I don't know why Amazon can't replace a lot of them with robotics. It seems like they probably already are, aren't they? Isn't that part of their issues that employees are running into the robots? But yeah, labor issues could be there if you have that kind of issue of finding, the trucking industry, that's certainly a big issue. So autonomous vehicles might be a solution there. Just make sure you don't get to greater than 100% of the market or the world population. Just make sure you're not at that point. And that's the problem with applying a growth rate to revenue, where you're just saying, hey, this percent, without sitting down and seeing what does that imply? What is that? How many customers is that? How many miles is that? Whatever that is. Okay. This is a really good exercise to go through because they ask this question in an interview. So if you go through this for this paper and you get the piano tuners question, you can go through it, or you can try to distract them. So, oh, that reminds me, we had to do that in my valuation, and then you can give them a much better answer and kind of get them off of piano tuners, or give them a very precise answer without explaining it and getting to the paper. Oh, there's 122,000 of them. But anyway, I was working on Monster for my paper, and I did some, just kind of throw them off. I had one guy who did interviews where he asked a question just to see if people had a sense of humor. And he was who's the guy that was on the airplane, the older gentleman, I can't remember his name, but he was this guy was a very distinguished, serious looking guy. And he would ask people, if you were a vegetable, what vegetable would you want to be and why? He would ask it so seriously. And boy, he had these systems guys just panicking. I don't know what to say. But if they ask that question, that question on how many piano tuners there are is a serious question. All right, you need dividend one. That's pretty easy. You look it up. What if your company doesn't pay dividends? All right, if your company doesn't pay dividends, then we're going to use free cash flow per share for equity. I can get it for you. You can get it from Bloomberg, or I can get it for you and show you how to calculate it. Generally, what you do is you take cash from operations minus CapEx divided by shares outstanding. That's the simplest way of doing it. That's very easy to do. You can just pull that number out. I don't like subtracting all of CapEx, but that's real close to what Bloomberg is doing. So if you get Bloomberg's number, you're going to have essentially the same number. And use that in place of dividends. So if you're not paying dividends, you can do that. Earnings per share one, you can get that from Yahoo Finance, but again, you might normalize it if your firm's been all over the place. So I'm real curious on Apple because I was kind of shocked with Apple. I'm worried I had. No, that's the number. Boy, I don't remember that, but I guess it's possible. Do y'all remember this? Another stock was up quite a bit. Not, over before this year. So I guess it's possible. Yeah. Boy, I don't own Apple stock right now. I guess I should, since Warren Buffett was getting into it. All right. You do need an inflation rate, but you use that. Sorry, I need to change my paper numbers. You had an inflation rate in paper 5, so just use that same inflation rate. And then you have a discount rate. You get that from paper 5 as well. And then you've got all the assumptions that you need. So for paper 5, you need a terminal growth rate, a short-term growth rate, a timing, a dividend one, EPS one, maybe normalized, or cash from operations, inflation, discount rate. Those are your inputs. You essentially need to explain them. The growth rates are the ones where you put most of the explanation on, and then you start your valuations. All right, what valuation models do you remember? Let's see what you have. I know what I'm supposed to do in this class, and we're probably not going to do them all. So what's the most basic one you learned? Say the whole thing. Dividend discount model. So value equals what? This formula, backwards and forwards. They asked this formula on the CFA exam. What is it? You remember?
Zero.
Now dividend zero means what? If you buy this stock, how much of dividend zero do you get? Zero. Because what is this dividend? Last 12 months. Okay, last dividend, but last 12 months dividend, or like the last year dividend. But we want next year's dividend. How we get next year's dividend? +1 plus growth. And what's the rest of it? It's kind of the rest of it for every other model too, isn't it? I know y'all know this. Someone yell it out. Yeah. All right. So y'all know this, right? You're graduating in finance. You've had this what in 6 classes now? You probably even had this in your accounting classes. So that's pretty common. What other models do you know? Free cash flow model. That's the one I'm supposed to be using. I don't know if y'all noticed they changed the name of this class to security analysis and corporate valuations. It's like, give me a break. We already got a paper. We're not going to do corporate valuations. We're going to do equity valuations. We're not do corporate valuation. But what is corporate valuation? Free cash flow divided by WACC minus the growth minus the value of debt. Y'all remember that? Did y'all use this formula in a class? The value of the firm, the free cash flow divided by the cost of capital minus the growth rate. And then to get the value of equity, you subtract out the value of debt. All right, why don't I want to do this one? Because this class is already hard enough. I don't want y'all to have to do WACC. WACC is a pain, isn't it? Y'all remember doing WACC? If we get the cost of debt, you got to figure out the market value of debt, which is crazy. So I don't want y'all to do that. So if they ask, say, yeah, we're doing just say we're doing a free cash flow model. Don't tell them you're only doing free cash flow equity, right? And I'll get out of this alive. I just don't want to do WACC. You've already done this. You probably did this in Catapacum's class. If y'all took Catapacum, you're in really good shape because he teaches what you need to know. He's a tough professor because he wants you to know this stuff. So you've already got it more than adequate. If you want to do this, this is fine. I'm just not requiring it. Now, the reason a lot of professors want us to do this is typically the one you see with investment bankers. It's pretty common, but I just don't want to go that hassle. If you want to cheat, Bloomberg will give the WACC for your company, but it's a horrible WACC, the way they calculate it. So, but the nice thing about their WACC is they will give you the details. So you could use their WACC and get the cost of debt and use that, and then use your cost of equity if you want to. So if you want to do this approach, you can. Taking out the market value of debt to me is a waste of time for most firms, mainly because, well, especially lately when the stock market was up a bunch, equity just so over dominates debt. It doesn't make, debt doesn't go up 40% and fall 40%. It might go up 5% and fall 5% or 10 or whatever. This year it's fallen a lot more, obviously. But it's an incredible amount of work for a very small change in your valuation. That's why I think it's a little bit overkill. And I've seen what investment bankers do, and it's a lot of detail, a lot of extra calculations that has very little impact on the valuation. So to me, it seems a little overkill. But you should know how to do this if you're going to interview with a investment bank. The nice thing about this is there's probably 50 YouTube videos out there to show you how to do this. So you can essentially teach yourself on that. But we can do the free cash flow to equity, which is all other models but use free cash flow to equity instead of dividends. All right, so that essentially isn't a new model. It's just, you just change what your input is. Instead of using dividends, use free cash flow per share. But free cash flow to equity, what's the difference between free cash flow and free cash flow to equity?
One question. So you're using free cash flow to find the value of equity?
Well, if you use the free cash flow of the firm, you're finding the value of the firm. What's the difference between free cash flow to the firm and free cash flow to equity? There's only one adjustment. You got to subtract out what? What belongs to the debt holders? Interest expense, right? So you take out interest expense. Over here, what did I say? Use CFO. Is CFO net of interest expense or gross of interest expense? You remember that? This is on the CFA exam. You have cash from operations, cash for investing. Man alive. In cash financing. Financing is dividends, debt, stock issuance. What should be in there? Should be interest expense, shouldn't it? Isn't interest expense a financing cash flow? But where is it? It's in CFO. That's one of the most common questions in the CFA exam. You're supposed to take interest expense, add it back to CFO and move it down to that. So the reason you can use CFO here is because it's already net of interest expense. It already is stockholders. So you don't have to make any adjustments. You can't use CFO if you're valuing the firm. You'd have to add interest expense back in. All right. That's when you use EBITDA or whatever, EBITDA, and adjust it for tax. So you get the interest expense added back in there, less the tax impact of interest expense. If you read my blog, I make that adjustment at the end only because Catapacan read my blog and he made me fix it because I kind of ignored it. So CFO is net of interest expense. So if you use CFO in your cash from free cash flow, then you are essentially using cash flow for equity. Right. So we're not going to use the free cash flow models. They're really not any different than the other models. It's just you use WACC for your discount rate. For here, you don't use WACC, you use KE. If you're using cash flow for equity, you use KE. If you're using cash flow of the firm, you use WACC. So that's the only thing. And, you know, for interviews, that's all you need to know. And I bet 80% of college students that are finance majors can't explain that. So if you understand that, you're still well ahead, even if you can't, you know, knock out a free cash flow model really fast. All right, so that's a good one. Other models that y'all know. So let's talk about what's the problem with discount model. Biggest problem in there. Dr. Demandaran says it works for about 5% of the stocks in the world. Why doesn't it work for the other 95%? Huh?
They don't.
Okay, no dividend. So we fix that using free cash flow per share. What's the other problem? What's not the same? I think you're hitting on it.
No.
What's the one number in here we may not want to be constant? Growth. It's constant growth. How many companies are growing at constant growth? Maybe Campbell's, maybe Walmart. You know, there's a few out there it could work with. But are Campbell Soup and Walmart paying out their free cash flow as a dividend, or are they paying out some other number? So those are the two biggest problems. What if you have a company like NVIDIA that's going to be growing whatever percent next year, or Costco 30% next year, whatever that number was, 12%, 13%. You can't use 12% here. If you use 12% here, what do you get? What's the firm value if your growth rate is greater than your discount rate? Would have seen it in Toy Story. Infinity and beyond, right? That's if your growth rate's greater than your discount rate, the firm is worth infinite value. So you can't do that. So you already know if your discount rate 6%, you already know your growth rate has to be less than 6%. You have no choice. I'm not giving you that choice. I mean, if you think your stock's worth more than infinity, that's fine. I'll sell you Apple for $8 billion and you can consider that a good deal. I'm willing to do that, but I doubt you really believe Apple's worth infinity. So that's a very huge limit on this model. So it would be nice, some of y'all have had my class before, what other model could we use that doesn't restrict you to one growth rate? H model, yeah. Y'all remember the H model? How many of y'all have never heard of the H model? Because if you haven't had me, you probably haven't heard of it. I don't think you had me for investments. So Colin, you had the H model. All right, so the H model is the dividend discount model. But we're going to add an extra period in there. We're going to add dividend 0 times something called H. Luke, do you remember it? Short-term growth minus long-term growth. We're going to add this little section here in the middle. And in this case, your short-term growth rate can be any number you want it to be. It can be 50%, 100%, 300%, negative 70%. It probably can't be negative 100% because then your dividends go to 0 or go negative. But it can be any number greater than negative 99%. And this growth right here is the long-term growth rate. So it will be lowered in your KE. So I love this model. I was never taught this model, but I found it in the footnotes of the CFA research of their example analyst report. And I thought, wow, this is great because I was taught a multi-period model. Those things are absolute pain. The formulas are just unyielding. They seem to grow like at 16% for 3 years, then 12% for 4 years. It's like this stepping down. And the formulas are just really complicated to get. I remember I took one graduate course and I made a mistake of telling the professor I thought his exams were too easy because he was counting out for really squirrely things. So he was like complaining to me because I was saying, why did you count out? He counted off because I didn't use a complete sentence and a math problem. I didn't say the answer is, I just put the answer in a box. So he counted off and he said, well, because the grades are so high. So I said, well, just make your exams harder. And now all that so offended him. So his final exam, I could tell he was mad. I knew he was going to ask. We hadn't even hardly covered it in the class. No one memorized this formula. I knew he was going to do it. I memorized the formula. The rest of the class left. They were all cussing. They were so mad. I was like, yeah, I got it right. But I knew he's going to do that. But that was ridiculous to put that formula on an exam with calculators. It's just a horrible formula. It's just horrible. The H model is a very simple formula, and it's actually, to me, makes even more sense. Because instead of you stair stepping down, it assumes you start at 18% and then over some period of time you glide down to your long-term growth rate. That makes sense to me. Most firms are going to grow 20% for 20 years and then drop down to 6% all of a sudden. It's going to be a gradual declining path. And that's what the H model does. It assumes you start at some number today, maybe 20%, and little by little over time, you'll get down to that. How long will it take? 2 times H is the time in years to get both short-term growth, long-term. So H is another word for half-life. What's the half-life of growth? So I think they're going to grow really fast next 10 years. So my H is 5. Now you're not saying if a growth rate is 20%, you're not saying they're going to grow 20% for 10 years. You're going to say they grow for 20 and then 18 and 16. It's just going to glide down to that long-term growth rate. And the midpoint is your H, that 5 in there. I had an engineering student tell me that they use this formula, a form like this all the time in engineering. I don't know the application, but it seems it's a simple way of kind of incorporating that higher growth into something. So pretty simple to do. It allows you to use some pretty crazy growth numbers for, a pretty extended period of time. It can still be a ridiculous assumption. If you say Google's is 100%, it's going to be 50 years. You can put it in a model and get a number, but it's probably not a good answer. But you can do that. You can't do that up here. You can't have 50% growth rates in these models. You can also use the free cash flow per share in this model as well. you don't have a dividend, you can do the H model, so it works as well. Okay, what other models do y'all remember?
HBR, the holding period return.
The holding period return is a return. I don't know how you would value a stock with that one. So how would you? You have to show me the math. So I'm not sure yet. But holding period return is a historical thing. It might help you kind of figure out what the market thinks the growth rate is going to be. Maybe.
Capitalism, yeah.
What? Say that again.
Is CAPM another one?
Well, CAPM is your discount rate, right? KE is your discount rate. So CAPM's in there. And that's the problem with. I mean, Anthony, you're exactly right. What does CAPM stand for? Capital Asset Pricing Model. It says it's a pricing model. How many prices does CAPM give you? Doesn't give you a price, does it? How many capital assets does it apply to? Only stocks. So it's not capital assets, it's a stock. It's not a pricing model, it's a discount rate, and it's not a model, it's a formula. So he should have called it the stock discount rate formula. SDRF is what he should have called it. But yeah, I mean, Anthony, he says it's a pricing model, but it's not. It's a cost of capital model. But we are using that in there. So y'all probably have heard of contingent claims approach. Did y'all cover that in any classes? Does that sound familiar? Anybody remember contingent claims? All right, so contingent claim is option pricing. So I'm trying to think if this applies to any of your firms. Boy. Pharmacies, Disney, maybe a Netflix, maybe a energy company. So what we're saying here is this firm has something. It's going to cost them some money to develop it. It won't cost them a lot. If it doesn't work, they just write that off. So Exxon's going to go, they think there may be oil wherever, maybe in Antarctica somewhere. And they have some lease to it. It's going to cost them $50 million to explore it. There's a good chance there's nothing there and they lose that 50 million. But if there's something there, it's worth tens of billions of dollars. What does that sound like? Sounds like a call option, doesn't it? Good chance, 90% chance, 90%, 5% chance you're going to lose 100% of your money. But it's only 50 million bucks, right? You buy a call option on Apple with a strike price of 200. Good chance that's going to be worthless. But there's also a chance you could make, their stock could go to $300. You paid $2, goes into you make $100 and you only invested $2. So it's option pricing. And they actually use option pricing models. I'm not going to ask y'all to do that in this class, but if you watch Darren's class, he actually has a model. He probably provides it online where you can use this model, produce this. The way I think of it is dividend discount model plus option pricing. Essentially what you're going to do is you're going to take that option, you're going to value that. So Exxon has this field, might have oil in it. It's going to cost them this much to value, to look at it. It could be worth this much. What would that be worth if it were an option? You got the probability that it could hit or not. Those kind of, we had, man, the guy in Costa Rica wanted me to do this. They wanted to do a gold mining dig. They thought there was some gold in the hills somewhere. And boy, he couldn't give me enough confidence to go for it. It was just like, I don't think I'm going to touch that. I said, oh no, someone found something. Yeah, I'm not going to go for it. But that's an option pricing. So that's part of the reason I'm interested in Meta, because Meta, this whole VR thing I'm looking at, yeah, it could be a flop. And I think there's a high probability it's a flop. But if it's not a flop, this company's going to really take off. That to me is kind of interesting. And, it kind of says, okay, good. I'm not going to put 90% of our portfolio in there, but 1%, I might be willing to let's let it ride. If it doesn't work, I just have a really poor performing stock. You could say that with Uber, with home delivery and some of the other stuff they're talking about, them kind of replacing UPS and FedEx and Amazon Prime. to deliver stuff with the gig economy or even autonomous vehicles, who knows? So I'm not saying you would do this, but you can think about this with your company. So why is this important? So you do the traditional approach and firm is well undervalued. What might explain that? Well, they may have that option there. So think about it. Does your firm have something that won't cost them much? You know, it's not going to destroy them. It's going to be expensive. We're talking about Exxon that makes, you know, maybe $5 billion and maybe this costs them $100 million, $200 million. So it's expensive, it's material. Good chance it's worthless, but the upside's massive. That's why media companies have a lot of optionality. You know, I mentioned Toy Story, the next Toy Story, the next Star Trek or Star Wars, or whatever, all these cartoon character movies. Something takes off. Not only do you get a really good movie take, but you can make 6 more sequels and they're all going to bring a lot of money in. In my lifetime, it was Jaws. Boy, by the 4th or 5th Jaws, we were so sick and tired of shark movies, but the first 3 did really, really well. And the first one, believe it or not, was really scary for me. I saw it a few years ago and I thought, man, that's the fakiest thing. When that leg comes floating down, I was like, that looks like a plastic leg, but I just about died when I saw it when I was, so you guys are much more, you know, I've seen a lot more real life graphic stuff. So this might explain why your firm is undervalued. So you might put that into your discussion. Not that you actually do contingent claim, but you think about it. So I don't know, do any of y'all think you have a company that has that kind of optionality to it? You might even do a Google contingent claim analysis for and put your company in there and just see if someone's written a paper on your company and see what that is. It's an interesting approach. All right, another one I like to do, I call it capitalized earnings. This is the suite model, so be careful. I have students like in an interview, like, yeah, I use capitalized earnings model. They're not going to have a clue what you're talking about. I have some students call this the CAPM. This is not the CAPM. I did not create the CAPM. So on this one, you have to explain it because no, you don't have to explain dividend discount model. You may have to explain the H model a little bit, but this one you'd have to explain because you're using a model no one else is going to understand. So essentially my assumption here is what if firm paid out 100% of earnings, limiting growth. So let's say you have this firm, maybe they're paying out 40% of earnings. Let's say what if they paid out 100% of earnings out? Why does it limit growth to? Well, according to the sustainable growth model, it limits growth to 0, but I'm going to say limits growth to inflation. My thought there is their revenues growth inflation, their cost of growth inflation, their earnings growth inflation. I heard Damodaran talking about this model, not mine. He doesn't know me from anybody, but talking about this approach. And he said it doesn't work because there's no way earnings can grow with inflation because revenues and expenses are both growing with inflation. I don't think he sat down and did the math, but you can try it. If your revenues grow with inflation and your cost growth inflation, your earnings growth inflation. So you do have inflationary growth. So I think he just said that off the top of his head. He hates this model. I'll tell you why I like it though. So the other thing you might say is, well, don't they have to like fix stores and repair things? Well, earnings is not cash. What's the biggest difference between earnings and cash? Well, depreciation. So they do have cash that they can do that kind of thing with. And essentially what I'm trying to do is, what is firm worth as is? No new capacity. Let's value the as is company exactly like it is. That works pretty well for a firm like Campbell Soup or Walmart, but I think it also works well for Apple and Google because what I want to know is how much of the value is today versus future hope fors. That's another reason I like it. How much is Google or Alphabet's value? How much is what they're doing today versus all the new stuff they're going to have to do in the future? And I know fors is not a word, but even with an apostrophe. So I find it interesting. One thing I remember in the 2008 crisis, I used to run this model, and Apple always looked real expensive this model until 2008, and then they looked cheap. I was thinking, that's interesting. Apple was trading cheap on this model. Maybe I should go out and buy Apple, and I didn't. I should have, but it was like, wow, that looks really, really cheap. There are firms where this valuation is higher than the dividend discount model. And those are firms that are probably paying dividends that are greater than free cash flow. It's not sustainable. So if you get a firm with a valuation, this valuation is greater than the value you're getting from dividend discount model. And that could be the case of I think even Campbell Soup, let's look at it. It's been a while since I looked at them, but last time I looked, it was very, very interesting. Let's see if that's still the case. Not quite, but you will see firms where their earnings per share is actually less than their dividends. So when you do that, you can get some strange answers. So I do want y'all to use this one. This one's real straightforward. You just use EPS 0 times 1 plus inflation divided by KE minus inflation. And it's really looks exactly like the dividend discount model, but we use earnings because we're going to have them pay out all of their earnings. We use inflation because they can't grow fast. It's a real simple approach. So I like it. I like to know, wow, how much of this stock's valuation is betting on the future with growth and new capacity and new markets and new whatever. All right, we'll do a few other of these next time. We got a couple more to go through. And one I'll actually provide to you, which is just an Excel model where you can build it yourself. All right, so you got to pick at least 3 of these, and then we'll talk about next class. We'll also talk about scenarios. And then the one thing I want to do, maybe after paper 7, is the football chart. Y'all all need to do a football chart. How many of y'all done a football chart before? I think we tried, didn't some of y'all tried it. So did we do it with your sector last semester?
Figure it out.
We tried. So we'll do that. You need to do it because we're seeing I think y'all did it in your paper, right? So you almost have to in the CFA research. It's become pretty common. I don't know where it came from. Someone started doing it and just all over the place. All right, we'll start their next class.